All right, welcome all. I'm Shlomo Cooper and I'm happy to start the Investors Club session for the 10th of August 2015. And stocks will be put to the test in week ahead. With the earnings season winding down, markets will turn their focus to data on the consumer and Fed speak in the week ahead. Stocks actually closed out the past week with losses and look set for another week of choppiness as oil moves closer to its 2015 lows and the commodities crash shows no signs of abating. Actually, we have here, we start with the performance table across all sorts of financial assets, major financial assets, and if we will take a look, the S&P 500, a lot of red in the sea. The S&P 500 closed down by a decline of more than 1.2%. The Russell 2000 got a hit with almost a decline of 2.5%. Actually, the Nasdaq 100, although declined almost 1.5%, still up for the year, a little bit below 7%. Here's the oil market. The USO, the ETF that tracks the oil market, is down the past week or over 6.5%, down almost 30% from the start of the year. Now, we saw the biotech crashed more than 3.5% for the week, but still it's up 21.5% year to date. Also, the energy got a hit after the oil market crashed with a decline of almost 3.5%. This is the worst sector since the start of the year. Over 15% of decline. So commodities continued to get crushed by oversupply and the strong dollar. The AAPL, as we can see here, is up 0.35% the past week, up 6.5% year to date, and global equities are in somewhat painful shape as breathe deteriorates in the US and the strong dollar. So last week rapidly increased the odds of a Federal Reserve hike in September. We'll talk about that later. We've also seen blow-ups in a number of secular growth stories, from tech, Apple, to media, too many names even to mention them, but lots of red the past week, and we're going to get an in-depth a look into what happened in Apple and whether it's worthwhile to consider investing in Apple in the coming days, or should we wait for another weakness in the stock. And we are also going to understand why Mickey Mouse of Disney actually got scared and why all the media names went down dramatically the past week. Through all of the equity market misfiring the last week, including a 7th straight down session for the Dow, which is the worst streak since 2011, economic data continues to come in quite strong, with consumers borrowing more than expected the past week. Also, we got strong demand reported at services industry firms the past week, and solid jobs growth on Friday. We're going to talk a little bit more on that later. So the summer doldrums is anything but in August of 2015, as all the eyes are now focused on the Fed and the first rate hike in almost a decade. Probably we're going to have it in September. By the way, if you remember, last week in the Investors Club, I showed you a statistical table of seasonality, and we saw that usually the summer is not a very good place for stocks, and except of July that we ended in green, and usually it's the bright spot among the months of the summer. August usually we saw is a weak month for stocks. So let's take a look at the technical setups. for major US equity indices as we head into a new trading week. And I want today to focus on the S&P 500. Here we have on the chart already that I'm broadcasting to you from my system, the S&P 500. This is the SPY, the ETF that tracks the S&P 500 on the daily chart, which means each bar here represents data of 1 day. So last week declines as we see it right now don't change the larger picture. The S&P is probably going to test price support of the rising 200 EMA. This is the orange line on my chart, and just pay attention how it served as a support towards the end of June and in the first week of July. Another support here on the 200 EMA exponential moving average towards the second half of July as well, and probably we are going to test it around 206. The 200 EMA we start this week, but the 200 period EMA has already proven itself, as we can see here on the chart, a number of times over the last few years, and especially in the last months. Of late, it made its mark, as we saw, holding at bay the declines that swept over the market in mid-June, doing the same at the beginning of July. Failing to do that won't be a big damage, as a very solid support lays not far beneath around 204, and the 204 actually, if I'll just take the support line here to show you that, this is a very, very solid support that we see right now on the chart. It gave a double bottom here in March twice. Also, it holded the market on the sell-off from June to July. So it seems every time we get to resistance, and we had a couple of resistance lately at the all-time highs. This is the all-time highs of May, and then the market tried to change this high once in the middle of June, and another change in the middle of July, but it couldn't actually get over that resistance, and actually we had a couple of lower highs here, and it seems every time we get to resistance we lose steam and lose momentum, and every time we get to support like the 204 on the SPY, we bounce. Now, this actually what is locking the prices in a very tight range since the start of the year for the last couple of months. But we have to understand that going forward, at some point, it's going to change. All right, at some point that's going to change, and that's what we have to keep an eye on. We are watching these levels. We are treating it cautiously. Going to the weekly chart. All right, this is the weekly chart. We see that in the big picture, nothing has changed there so far. This is a very, very quality long-term uptrend. But still, looking on the large time frame, we are still logged here in the tight range I mentioned on the daily chart. And let's just put here the lines. Going to the 30 minutes trading time frame, which is what I consider to be a long-term intraday chart for active day traders like us. So we have here the 5 days moving average on the 30 minutes time frame, and it actually felt at the beginning of the week on the 3rd of August that actually a couple of times the market rejected the declining moving average here, the 5 days moving average. Tried to bounce over it on Wednesday, and it seems to, and at the moment it seemed it has a potential, to hold. But here comes Thursday, and actually shuffled all the cards in the deck, and and the market went down actually, and it left no area to suspect that the market is on the rising line. And then came Friday with a non-farm jobs report, which still was good, but the market is now afraid that a strong data is going, to get the Fed to hike rate. So Friday continues actually the decline of Thursday. At the beginning of the new week, we want to look around the 209. This is where the 30-day, this is where the 5 days moving average right now stands. Right now the market is guilty till proved otherwise, so we want to see maybe the continues of the second half of the day rally on Friday back to the 209, and then we would like to see if this area can serves as a support, as a resistance. Actually, this area is a support area from previous week, so we want to see exchange of roles from support to resistance, and if so, this will be the place to play the short side. We should be cautious. Every rally should be shorted until we get a bounce over the declining 5 days moving average. And maybe the best thing for the bulls stance will be a bounce above the 5 days moving average, then a test of it, a retest, and if the retest succeed, then we can get back to longs. All right. From there, let's go to the economic scorecard. What happened last week? And it was a pretty good week for economic data, with a solid employment situation report, strong auto sales. We had a bump up in consumer credit, which is very, very good, which means American citizens are buying more, consuming more. This is, of course, a very good information for the retailers. We saw a blowout ISM services, a pretty decent manufacturing data, while construction spending missed. There were big upward revisions to the prior month's data, and while consumer spending didn't blow the doors off by any means, it was a healthy pace. Let's move forward, and here we see also, of course, the non-farm payroll, which moved a little bit below expectations at 215,000 new positions in US jobs market. But of course, any figure right now over 200,000 should be treated as a good figure. Looking forward to this week. There is a diverse universe of data this week of JOLTS. JOLTS opening new jobs will get a lot of attention, as every piece of labor market data ahead of the September Federal Reserve meeting counts. We know also that the Federal Reserve take into consideration very much these figures. Also, this is going to be published on Wednesday. On Thursday, we are going to have retail sales. Actually, Thursday is one of the most busiest days in the economic calendar. So we have retail sales, and it will be closely watched as well, while industrial production and capacity utilization this Friday will give further insight into the pressure on manufacturing, exports, and oil production. Moving forward, let's right now see what's happening right now in the earnings season. With more than 2,300 companies having reported and only 7 trading days left in the reporting period, at least in the formal trading period, the second quarter earnings season is winding down. We have roughly 500 more reports left, so absolutely it's going to be tough for the overall earnings season averages and trends to change much. So here's some good rundown of where things right now stand. Last week we saw a lot less beats on bottom line earning per share estimates, and it dropped the overall earnings beat rate. versus consensus analyst expectations. For the full season, down to 61.1%. Here we see bars for each quarter since the second quarter of 1999. So we have a lot of data here, and this is this quarter earnings at 61.1 on the bit level of earning per share line. By the way, last Friday, this time the bit rate was above 64%. So now we are looking a quarter-on-quarter reading that's just barely positive, while the earnings bit rate dipped last week. Actually, if we are going to the revenue bit rate, it remains steady at just above the 50% mark. Nothing, to show off about, because at 52.7%, it's still much down from previous quarters. As of today, 52.7% of companies that have reported this season have reported revenues that were higher than consensus analyst estimates. So how are stocks performing in reaction to their earnings report this season? This is a very good question to ask. And as of today, and we see it here right now on the chart, the average stock that had reported had gained 0.06%, whether it beated or disappointed Wall Street on its earnings reaction day. Last week, this number was much more positive, but given that the Dow fell every day last week, it's not surprising that it dropped, and actually I got surprised that it stayed in positive territory when we ran these calculations. Actually, I expected to see the average reaction day for the stock that reported in the red territory. All right. If you are an active market participant, and I believe most of you are, you know that forward guidance probably has the biggest impact on how a stock performs in reaction to its earnings report. So here we take a look at the average earnings reaction day change for stocks in each sector that have raised or lowered guidance this season. Here you can see where stocks in a sector like healthcare, for example. All right, here's my laser. So here's the healthcare, for example, which have extremely lofty expectations these days, that lower guidance have gotten absolutely crushed on their earnings reaction days this season. The average healthcare stock that has lowered guidance this season has declined 13.77% on its earnings reaction day. And let's just understand what that means. So let's get back here to the daily chart and just let's take a couple of stocks that actually disappointed and lowered guidance. For example, INSY. All right, INSY, which went down 12% the past week, or BKD that we also have in our swing report. We are holding it in our New York strategy, went down 12%, and we made a great, we still have a great trade on BKD. Also Acadia, ACAD, went down 19%, another biotech firm that disappointed Wall Street the past week. Maybe talking about the New York strategy, and maybe we are going to dedicate a full session for that strategy, which is a swing strategy. It averaged a gain of 40% for any of the last 5 years. So this is a great strategy to follow it, and you have all the calls, you have all the picks, stock picks in the daily report that we deliver to your email every morning. And the best one last week, and I think one of the best since the start of the year, was Icon. We took Icon. I just want to show you Icon from last week. All right, so actually we had a call on Icon you see that this stock is just on the declining mode, and we took icon just after the last low below 20. Actually, we got a field on 1990. All right, and that was just on last Thursday. And as you see, all right, we got our fill here on Thursday, and guys, we just opened our eyes on Friday to see this stock crushed by 20%. And of course, that was a great, this is still a great trade we have on the short side on Icon. Right now up in my portfolio, $2,500. This is great. All right, back to the presentation. What we are seeing in the biotech is actually conversely to that, we have all the stocks in the biotech that actually raised guidance and for that a stock hasn't resulted in big gains. Only the average healthcare name that has raised guidance has rallied 5.7% on its earnings reaction day. Stocks in the defensive consumer staples, for example, that have raised guidance this season have averaged gains of 13.29%, very much on their earnings reaction days. Opposite to that, those that lowered guidance went down more than 7.5%. It's also interesting to look at energy and materials sectors. All right, these are the most beaten sectors since the start of the year. Companies that have lowered guidance for these two sectors haven't gotten hit hard at all, averaging a decline of roughly 3% here on the energy and here's on the materials. Investors expected weakness in these two sectors, so weak guidance was mostly priced in, baked into the price of the stocks. Raised guidance for stocks in these two sectors has resulted in big gains. The average material stock that has raised guidance has gained 11.25% on its earnings reaction day, and also the energy went up dramatically. And for example, on that we had RIG on Thursday that went up something like 15%, and also MRD more than 15.8% the past week. So these trends are important to keep in mind when investing around the earnings, and we are going to make a lot of investment and trading around the earnings in the following weeks. Stocks in hot sectors with lofty expectations always get crushed, like the biotech and the healthcare, always get crushed when they show any weakness, and they don't benefit as much when they post strong results. Stocks in beaten down sectors that post weak numbers don't get hit nearly as hard as we see here in the energy and materials, while the names that manage to post positive or even just inline results in weak sectors like the energy and materials typically post big gains. Alright, from here, let's get to the micro, and one of the most interesting areas in the past week, an area that we just made great calls on the short side, and it was just short since Wednesday till Friday, was cables, was all of the media sector. So let's understand what happened in the media sector, and it was lots of things happened there in the past week. So in terms of sector-specific market performance last week, media took the spotlight. For years now, media companies have thrived on the idea of the bundle, where cable or satellite companies and ultimately the customer, we pay the content producers a monthly fee for each household that receives a network's signal. Content providers also usually require that cable companies offer their networks to every household they serve, whether the customer wants it or not. So the poster child of the bundle has been Disney and its ESPN franchise. In most cases, if you are a basic cable subscriber, for every household that receives the ESPN channel, Disney gets more than $6 per month. Now, that fee is paid to Disney regardless of whether or not any TVs in the house turn into ESPN. So, for someone who is an avid sport fan, I think $6 per month is completely reasonable. But for Americans who have little interest in the sports and programming that ESPN offers, I think $6 per month is nothing more than a subsidy for the people who do watch it. Now, over the years, there have been complaints that subscribers should be able to pay for only the channels they want, but the content producers want no part of that. Their stance, which they have successfully held, is that if you want to offer their signal, it's either all or nothing. Before the proliferation of video over the internet and other alternatives, cable was the only game in town. The only choice consumers had was to put up with the bundle or go to rabbit ears. With the ability now to stream content over the internet and new technologies and alternatives emerging, consumers right now are increasingly realizing that they shouldn't have to pay for the channels they don't watch. If you don't like sports, you shouldn't have to pay for ESPN. And similarly, but to a lesser degree, someone who has no interest in watching Canadian house flipping shows on HGTV or shows about wedding dresses on TLC shouldn't have to pay for those either. In terms of new technologies, Netflix has been the obvious winner, as its performance since its first announced its streaming service back in early 2007, and here we see it on the chart, has been nothing short of astounding. For a company that has been written off for dead as often as Netflix has in the last decade, the company has established itself as a primary player in the media space going forward. Now, while Netflix has gained, and here we see more than 3,220 in the past decade, or in the past 8 years, that means if you put on Netflix something like $10,000 back in 2007, you now sit on a pile of cash of $322,000. Wow, that's a lot. So while Netflix has gained, media companies that have thrived on the bundle haven't exactly been hurt. As shown here on the chart, so over the time that NFLX rallied over 3,000%, Disney in the same time went up over 200%. With all the disruption in media content delivery and consumption, the writing has been on the Wall Street for the media companies and their bundle for some time now, and the question has been when the tipping point would come. Now, based on the action the past week, it seems the tipping point may have come last week, and sometimes all it takes is only one person to get the ball rolling. And last week, that one person was Disney CEO Bob Iger in the company's Q3 earnings conference call. And in his opening remarks, Iger noted that, and I just took here a snapshot of his sayings, and let's read it together to understand. He says, we are realists about the business and about the impact technology has had on how product is distributed, marketed, and consumed. We are also quite mindful of potential trends among younger audiences in particular, many of whom consume television in very different ways than the generation before them. Economics have also played a part in change, and both cost and value are under a consumer microscope. All of this has and will continue to put pressure on the multi-touch channel ecosystem, which has seen a decline in overall households as well as growth in so-called skinny or cable-light packages. ESPN has experienced some modest sub losses, although those have been less than reported by one of the prominent research firms, blah blah blah, and the vast majority of them, 80%, were due to decreases in multi-channel household, with only a small percentage due to skinny packages. So this is actually what got Mickey Mouse too scared, and let's have a look at what happened to Disney stock. So you don't have to look too closely at this chart to see the impact Iger's comment had on the Disney's stock. In the 2 days following its earnings report, Tuesday afternoon, shares of Disney actually fell more than 11%. The second chart, the next chart, all right, the next chart shows historical 2 days changes for Disney going back to 1974. Over the 40 plus year span, 10% 2-day declines have been rare, with the last one occurring during the financial crisis. All right. Okay, sorry for that. So here actually we put a line in the minus 10%, and as you can see, this is the boundary we sketched. And right now, the last week Disney went down over 10%, and the last time, as we see, was 2008. All right, that's a long time ago. Just to understand what happens in Disney. Now, Disney's plunge on Wednesday and Thursday actually sent shockwaves all around the entire media space. So the table here shows the performance of NFLX, which stands at the top of this list, and the stocks in the S&P 500 media group last week. And as shown, Disney, which went down 10% the past week, wasn't even the worst performer on the week. Viacom, VIAB, went down more than 20%. That was actually the worst performer, but we had also, so it lost fifth of its value in 2 days. 21st Century Fox, FOXA, went down 13%, and if you watch the Discovery channel, then DISCA, here it is, DISCA, Discovery, went down almost 12%, much worse than what happened in the S&P 500. Actually, in fact, whether you were a content producer or a content deliverer in the S&P 500 media group this week, your stock was down. At the same time, all of their pain was NFLX, which gained as the stock was up over 6%. Let's just have a quick look on Netflix on the chart. So actually we see that Netflix doesn't stop rising, and here we had NFLX a couple of weeks ago going back to $100 after it made a split of 7-1, but since then, since the $100 split, it just went another 25%. Actually, I'm very, very proud about Netflix. We just commentated about Netflix a couple of months ago, and we recommended our traders and our investors to consider to get a stake in Netflix. And right now we are up about 25% in the past couple of weeks. So this is a great job for all the traders and investors here that took the recommendation. Okay, while some of the moves last week may have been overdone, once the market starts to react to these trends, they tend to accelerate, bringing about further change. So an article on Recode, which was posted by Peter Kafka on Thursday, touched on this point using recent comments from Bob Iger as an example. And last week before earnings, the article noted that Bob Iger told CNBC that Disney was open to offering ESPN directly to consumers over the internet, but not any time in the next 5 years. Then, after earnings and worries over ESPN and the bundle, Iger went back on CNBC and opened the door a little wider. So actually, it seems that from no way to one day, it changed its speech to down the road to who knows. Pretty quickly it was, right? Okay. Another stock that took the so here we see actually the divergence between Netflix and all other media stock. We take a look on the past months for Netflix, which is in the red line, and other stocks like Disney, Discovery, and here we have all the colors of the lines for each stock in the media group that we have on this chart. So just see that even prior to last week, for the last week's sell-off in the media group, we already saw the divergence between Netflix and the other media stocks, but absolutely last week just took Netflix off. It took a lift off, and right now the divergence is much bigger, and it's very hard to imagine this gap between them or the divergence anytime soon getting close. Media stocks aren't the only formerly solid performers under pressure lately. In shares of Apple, and let's put Apple on the chart, and I know Apple receives lots of attention from our traders and the investors, so here we see Apple on the daily chart, and shares of Apple endured their third 5-day losing streak in the last month, but this one has been particularly painful for Apple bulls, as the stock is down over 7% in that span in the last streak of a 5 days decline. Now, with that decline earlier last week, the stock was trading more than 3.4 standard deviations below its 50 days moving average, and we talked a little bit about this tool last week, how to use actually a Bollinger Bands in order to measure oversold and overbought territory for any stock. And to put that really in perspective, the stock hasn't been that oversold based on the measure in more than 12 years. It happened, last time it happened was April 2003. In addition to trading well below the 50 days moving average, and this is the green line on my chart, this is the 50 days moving average, shows, and look how Apple is right now trading very, very deep below the 50 days moving average. Shares of Apple also closed below the 200 daily moving average. This is the orange line on my chart. You can see it right now. And that was for the first time since September 2013. Now, Apple is down over 10% also since being added to the Dow Jones index. There has been a lot of discussion regarding Apple's close here below the 200 moving average and how the stock traded following the last one or two times it traded below that line. In order to give a more complete picture of how the stock has fared following similar crosses, we have the next table right now, which actually lists each time since 1982 that shares of Apple closed below the 200 daily moving average after not closing below that level in the prior 6 months. So, as shown, there has been 17 prior occurrences that fit this criteria. We also put here on the chart the direction of the 200 daily moving average before the cross of the 200 daily moving average, whether the angle there was rising or falling. Also, you have here the performance of Apple in percentage after 1 week, 1 month, 3 months, and 6 months after the bearish cross, or what's considered usually by traders and investors to be a bearish cross. So as we see, we have 17 prior occurrences. Overall, the 1 week period, and we have here all the averages, take a look. The 1 week period following these occurrences has been very weak for Apple, as the stock has fallen an average of 3.1%. We see it here with positive returns in only 29% of that time. And we have, by the way, minus 3.7% when 200 daily moving average is rising, and minus 2.3% when the 200 daily moving average is on falling angle. Though Apple's return were looking further out, though Apple's return were more positive, 1 month later, Apple has generally seen gains, 2.04 on average. 3 months later, the returns are positive overall, but mixed, depending on whether or not the 200 moving average was rising or falling. You see here the divergence. Finally, in the 6 months following prior occurrences where Apple closed below its 200 moving average, the stock has generally traded higher with positive returns more than 70% of the time, up almost 6.2% on average. However, it does serve as a reminder that the conventional wisdom, the conventional technical analysis, which suggests that downside crossovers of the 200 moving average are a bearish signal, probably isn't the best advice either. Okay. So by itself, this analysis is probably not the best reason to go out and buy the stock. Usually, you should base your decision on more, on more pieces of data. This is one piece of the data, but still, we understand absolutely a bearish cross, or what called a bearish cross. Usually, even in the short term, it tend to be a bullish cross. All right. Moving forward, from a technical perspective, the 200 moving average got a lot of attention last week, but that wasn't the only key support that Apple broke. So here we show a weekly candle chart of Apple since October 2011, and as shown, it broke key support. This is the horizontal support coming back from last December 2014, and that was a very, very bearish signal. It's entirely possible that last week was entirely driven by technicals, by sentiment, and even by new positioning. If that's the case, I'm quite nervous about the name going forward, as there is nothing in the above to suggest support around these levels. Just see how this is a clear void to the downside, and after the last resistance failed to have a support, we don't have here the change between a resistance to a support, so the retest here hasn't succeeded. That is sending us some big hints that maybe the stock has more room to go down, and maybe and the next support seems to be on the chart is only the area around the $100 level. Now, I really like Apple from the fundamental point of view, but why buying Apple for $115 if you can buy it for $105 or maybe even $100 in a couple of weeks? So I think Apple is still the best by far the best company in the world, much better than any other stock or any other, at least, company in the world. I think Apple stock is going to climb further in the long run, but if we want to really time it right, our next entry into Apple, I think we would better give it some more time and try to see if we can have another weakness in Apple. Maybe all the weakness is not out of the bag yet. All right. And talking about sentiment, sentiment especially is making me worry. Very few are outright bearish on that stock. If you look on the percentage of short sellers in Apple, it's only 1.5%, very, very low levels of short positions in Apple, and many more are just wondering when they can get in to buy the dip. And and this just can send when everyone are thinking alike, usually the stock market is just sending you back to the drawing table, sending you giving you or delivering you some kind of lesson. And I'm a little bit worried that investors are going in the coming weeks to get such a lesson. Okay, let's move forward, and I want to just to summarize this session by saying a couple of things going forward to this week. So, couple of final words regarding this week. The Fed remains, as we said, a key obsession with traders, poised to react to each piece of incoming economic news for what it may mean to the Fed's upcoming interest rate decision. We are going to have this another meeting of the Fed only in mid-September. Markets shifted more heavily to price in a September rate hike by the Fed after Friday's July jobs report, which showed solid growth of 215,000 payrolls and a steady unemployment rate of 5.3%. Topping the upcoming data calendar is Thursday's July retail sales. At this stage, it's getting to the point where it's hard to imagine the Fed, in my reading, not going if the data continues at current levels. There are also speeches this week by Atlanta Fed President Dennis Lockhart. This is going to be handled on Monday, and New York Fed President William Dudley. And in the past week, Lockhart sent ripples through the markets when he said that, in his view, he saw no reason to hold off on a September rate hike. Now, Dudley is part of the core of the Fed closest to Fed Chairwoman Janet Yellen, and he speaks on Wednesday in Rochester, New York, on workforce development, but he's also taking questions, so it can be a very volatile session when actually all traders are going to listen not to the market but to Dudley words. I think stocks will listen to the Fed speak after the payroll data right now out. The market is less likely to respond to earnings in the coming week, as most companies have now already reported. As we said, we are just in the last mile of the earnings season. The market becomes less sensitive to the last 20% because it's going to look similar to companies that already reported. Nothing is going to be new there. Then you start turning to the economic data, and the reality is this is August, and the response to everything is going to be a lot more muted unless there is something really big headline out of China or something equally magnitude. I think from an investor's point of view, the Fed moving is going to be a good thing. A good thing after it happens, even if it happens in September. We have zero interest rates. If the Fed is leaving it at zero, they are basically telling you that don't even think we can get to 25 basis points increase without upsetting the market and the economy. A move to 25 basis points is not someone taking the punch bowl away from the party. It's more like, we think you can do this on your own, son. You don't have to co-sign your lease anymore. Consumer-related data will be important also in the coming week, and the Fed will be watching all that data. You've got 5 more weeks of data, and there are plenty of things that could happen on the geopolitical front. Greece has to come to some agreement with their reconstituted Troika. Also, there is still risk out there from other sources like the Middle East and China. All the issues surrounding Iran in the Middle East, and the agreement between Iran and the big nations like US and the big nations in Europe. The fiscal issue in the US is also going to come back on the fire. So there's a lot of things that contribute to uncertainty. So I believe we are going to see much more of the choppiness and going sideways. And just remember the boundaries of the range. We are still in there right now. Buy the dips, sell the rallies. Guys, I wish each and every one of you a very great and successful trading week. Hopefully you are all going to make money this week. We didn't have time to go over the IPOs last week, but we had a couple of great IPOs. If I just take another minute on that, let's get back to the intraday chart. This is the 5 minutes chart. I'll put here AIMT. This is a Barak IPO. Went on the wire on Thursday, and just look on that. Wow, is that is not magnificent or what? This is the first 5 minutes of the day. This stock started at 32 minutes past 10 o'clock on Thursday. It started with a gain of 25%, but look on this great movement. It went up all the way from $19 to $26. This is a $7 rally in 2 hours, and this is why we like IPOs. So guys, take care, have the best week in trading and investment, and I'll see you all next week. Scott is going shortly to get the microphone and to start Monday's trading session. Take care all. Bye bye.